The recent surge in global crude oil prices has been driven by geopolitical tensions following the collapse of peace talks in Islamabad and a reported U.S. naval interdiction targeting Iranian ports. This situation has raised significant concerns regarding supply and insurance risks for shipping through the strategically vital Strait of Hormuz, which is responsible for approximately 20% of global oil flows. On April 1st, commercial liquefied petroleum gas (LPG) prices were raised in India, marking the beginning of a series of price adjustments in response to international market fluctuations. The breakdown of 21-hour peace negotiations in Islamabad led to President Donald Trump ordering the U.S. Navy to interdict vessels at Iranian ports. This decision resulted in an immediate market shock, with crude prices spiking by approximately 7 to 8%, briefly trading above $100 to $104 per barrel on April 1st. By April 14th, while the markets had slightly adjusted and pared some of the initial gains, crude oil prices remained significantly elevated compared to pre-escalation levels. Insurers and shipping companies began to slow traffic through the Strait of Hormuz, reflecting heightened logistical risks and market volatility. Despite these external pressures, Indian state-run oil marketing companies, OMCs, maintained retail petrol and diesel prices unchanged for several days, with petrol priced at 94.77 Indian rupees and diesel at 87.67 Indian rupees in Delhi. However, analysts have warned that if elevated crude prices persist, domestic pump rates could be revised upward within the next week, potentially leading to broader inflationary impacts. The Indian economy is particularly sensitive to fluctuations in global crude prices, as the country imports the majority of its crude oil. The retail prices of fuel are influenced not only by international crude prices but also by the rupee-dollar exchange rate, taxes imposed by central and state governments, and the pricing policies of OMCs. Analysts estimate that for every $10 increase in crude prices, India's import bill could rise by approximately $13 to $14 billion, linking sustained crude spikes to inflation and currency pressures. The political landscape in India adds another layer of complexity, as the sensitivity surrounding state elections has led to a temporary pause in domestic price revisions. While retail petrol prices remain below 100 Indian rupees per litre in Delhi, they exceed this threshold in several major cities, including Bengaluru, Hyderabad, and Kolkata. Additionally, commercial fuels such as 19 kg LPG cylinders and aviation fuel have already seen significant price increases, which are expected to have knock-on effects for businesses and airfares. In summary, the geopolitical escalation surrounding the failed peace talks and U.S. naval actions has created a precarious situation for global oil markets, with immediate implications for supply chains and domestic pricing in India. The ongoing volatility in crude prices poses a risk of inflation and economic strain, particularly as the country navigates the complexities of its energy imports and domestic fuel pricing strategies. Reporting for the Newsroom Global, don't forget to subscribe.